Good evening, guys. It's Sterling here with a daily market review for September 24th, 2013. We are looking at a chart of the pound, and as far as the pound is concerned, getting into today's price action, we had a really nice setup on the pound, and we'll get into that, obviously. So, going into the pound here, the first point I want to talk about was the initial level here, and that was 60.25. We had two candles opening and closing below the stop run point, and that was what threw that level out. Had that not opened and closed below that level twice, and it would have been a viable option. I was actually watching that trade as well, and once we opened and closed below it twice, that was what threw the trade out for me, and was the catalyst, or was the basic catalyst for saying that it wasn't a viable trade based on the confirming entry rules. So moving forward, something I wasn't around from was the next test into this point. We almost confirmed up, never quite confirmed back to the upside. So we had quite a gap in between the two levels. But our lower level for the day was the 59.59 level, one spot 59.59, and this is where the best trade came in now, and this makes me sick to my stomach thinking about it. But looking at this trade, we had an absolutely beautiful stop run of of the lows. Came into 59.59. It's a really solid point. It's the hourly 200 EMA, and it's actually a really solid point in the past. And so, although I felt it was kind of unlikely we got there, I've been mentioning it over the last couple of days because of the fact that it is such a key point. So what we had was a typical, what I term as a typical New York third push. A lot of times you'll see the market set a double top, double bottom, and then New York will give this huge candle out of nowhere. And it's one of the things that happens in New York specifically more often than really any other time that I've seen, and it's one super aggressive through a very clear high, through a very clear low, often into the next level, and that's what we had here. It was a very aggressive candle through a clear low into the next level, and this candle initially was their stop run candle. When the next candle did not confirm up, the next candle becomes our new stop run candle. The following candle after that confirmed up, and the following candle after that confirmed down. I was having some issues getting into the room this morning, and as luck would have it, this thing was setting up as I was talking to Omnovia, and so I was distracted this time. Normally, I got no excuse for it. I should have been in that trade. Unfortunately, just never looked back at the chart because I had it sitting there on the euro, didn't have a viable level on the euro, and like I said, should have looked back on it. But I was glad to see, at the very least, so many of you guys making money off that trade. So nice trade, nothing wrong with it if you guys took it. Really solid level, solid confirmation up, really deep pullback. One of the biggest benefits to this trade is that at the depth of the pullback, you were about 4 pips away from the lows. So even if you might have had some risks, or might have had some doubts about the trade for one reason or the other, you had so much benefit given the fact that it was so close to those lows. So anyways, nice trade. Glad to see so many taking that, and it was a relatively low stress trade. I mean, you got towards the end of New York, and you did create a stop run on some previous highs, but you never confirmed down to signal an exit, and that's a good thing, obviously, because it continued up from there and hit your take profit. So nice trade, guys. Moving on to the euro. Now we'll look at the euro, we initially, with the euro, we had one spot 3,500. This is a level we talked about in the room, and just mentioning this point, I had a question in the room of why was that not a viable short. Well, it wasn't a viable short for the basic reason that you open and close beyond a level twice, and that's enough for me to throw out that level. So when we opened and closed above that twice. Again, a trade that I was actually watching at the time, and both were setting up, both were setting up inverse the pound and the euro, which is one of the risky parts about it. But also, when you closed above that level twice, that was a immediate no-go for that level. So continuing on, when we came back into it from the other side, never confirmed up to validate a long entry, and then coming down a bit further, we still had 30. Zoom out a little bit. I'll show you this next level. We had 34.85, came to this point, never confirmed up, and then continuing down. This wasn't a level. This was just something that I had drawn in. But if you look back at the price, kind of go way back for the test on this one. Okay, so even on the last test, and this is what I wanted to show you, that where that thing was creating stop run on, you just didn't have, I mean, there was some previous tests back through there, but you just didn't have really any reason to consider it as a super viable point, in my opinion, and thus not a trade that I was necessarily looking at. Now, you did validate, or you did provide a confirming entry up at the same time as the pound was, but the trouble is you just didn't have the level. That was just a point we had drawn in there, not really anything that I was necessarily looking at. So what we had, and let's see, I had one more point I wanted to mention here. Make sure I hit that. Okay, I think that might have been it, actually. Okay, so with the euro, one of the, and we can talk about a backside of the level trade here. One of the trades that we were talking about in the room was the euro trade here, and this short on the backside of the level. So this brings out a good point, and it brings out how we can adapt to current market conditions. Okay, so we had a valid short opportunity off of the backside of the 34.85 level, and if you took it on a good pullback, then at the close of the New York session, well, you probably made a little bit of money on it. I wasn't in that trade either, and the reason I didn't take that trade was the basic reasoning behind that is, in a normal market, we look for the market to run 90 pips. So that's a pretty average standard. So let's assume that this black line represents a 90 pip move. It obviously doesn't, because the market's been pretty stagnant, but let's just assume it does. So if this trade was setting up and the market had already moved 90 pips, and this red line represents 90 pips from the high to its low, then obviously we wouldn't take the short here, because the market has already moved its 90 pips for the day, and given the fact that the move is over, it becomes much less likely that you're going to actually get some continuation. So another way to say that is, we don't look to take a continuation trade when the market has already ran its typical push for the day. So given the fact that over the last 3 days the biggest move we've seen is 60 pips, at this point, earlier in the day during the European London session, we had seen a 60 pip move. So I was essentially applying the same rules, and that is, if the market has hit its typical move for the day, and lately, the last couple of days, that's been the typical move at best. So if the market has hit its typical move already, then we don't want to take a continuation trade. And that's why, if you combine that point with the fact that the pound had already given what looked like a solid stop run of major lows, and kind of factoring all that together, that's what kept me on that trade. Again, it would have ended up, in hindsight, as a profitable trade, but that's essentially what I was explaining in the room as to why I didn't like that trade. Okay, so going into the pound here, looking at the pound, one of the things that is normally quite rare for Chad and I to be as different as we are on the cycle, and the way that he has this cycle laid out, and I could just pop up the chart here for you. Let me make sure I have that. Well, I'll just draw it out. Basically, the way he had drawn this out is that we had 2 cycles within the day. Within this first day, So if that was the case, then that would mean that this was the first push up, and thus we have a failed first push here and a first true push to the downside. So the way the way I've been looking at this, and still the way I feel the highest probability is that we've seen a first push, a second push, and a third push. So again, it's quite rare that we differ from that aspect. But I'll walk through why I believe the way I do with this cycle, and it really, at this point, I don't think it's going to matter much, because at the end of a cycle, you always look to trade the manipulation points to both sides of the price anyways. So anyway this pans out, it's really not going to, again, it's not going to matter all that much, but because we'll be looking at the manipulation points to both sides of the price. But the reason that I'd call that all one cycle is because I would rather see or I don't want to say rather see, we generally see a cycle occurring one cycle per 24-hour period. So if that move had been, let's say, 170, 180, in other words, excessively over a typical average everyday move, then maybe we could call it two cycles within that move if you see a clear retracement separating a first push from a second push. But we do have a first push down, which is about 80 pips, a little bit of a stall, and then a second push down, which is about 80 pips again. So you could start to say that that is possible. The reason that I hesitate to say that, though, that the cycle was complete here, is that that would mean that the cycle was completed in less than 48 hours. And that is typically not the case. So from a time standpoint, there's three criteria that make up a cycle: time, overall move, and three individual cycles of 90 pips or more. So if you look at all three of those factors, the way that all three of those factors come together in the most typical fashion, or the most picturesque fashion, is if we lay the cycles out the way I have them laid out here. And that's why I believe the way I do. First push back here on Thursday, second push on Friday, and the third push going into Monday. So that means that that move occurred over 1 day, 2 days, 3 days. So there's the time criteria. The overall move is satisfied. If we measure from here all the way down to here, that's 190 pips. But if we come up to here, we only have a 160 pip move. So at this point, the overall move isn't satisfied at that level. And again, that's another reason. So not only time, but also overall move is another reason why I think this is the end of the third push, not back here. And three individual cycles of 90 pips or more, laying it out this way, again, that's how we come with, we lay out three individual cycles. So one of the reasons I think Chad was more aggressive with calling it a finish cycle earlier is that we have been running a very stagnant market, except for the news-based move that caused the huge move to the upside. So with that, and kind of adapting to that tighter market, that might have been the case, but we continue to make those moves, and that's again why I have it laid out like this. So if you have any questions on that, feel free to shoot, and we will get back with you as far as cycles concerned. Hopefully we've laid it out so you have a little bit more perspective as to why there's a little bit of a difference in opinion. And as as you go through the months, there's the vast majority of the time we're very similar when it comes to cycle. There's those 1 or 2 times every 3-4 months where we see it differently, and at the end of the day, as I always say, the manipulation is going to be the guide. So when that happens, even the person that ends up, or even the cycle, I guess I'll say, that ends up being the correct cycle, even if you were looking at the cycle the wrong way, the manipulation is going to protect you, or generally going to serve as a protection. So that's the case today. Let's just assume that the short cycle he has laid out is right, and that would make this a possible first push down. What's going to protect me from taking a loss on that? Well, what's going to protect me is that when it comes into this low to give a stop run on the lows, it's not going to create the stop run. It's simply going to blow right through it. If in fact, and again, that's the highest probability, if in fact the cycle is laid out the way he has it. So The manipulation is the guide always, and it's the protection, and that's really the key. Alright, so if we've completed the cycle down, or if that's the way I'm going to be looking at it, then obviously we're looking at the manipulation points to both sides of the price. And when it comes to look at the manipulation points to both sides of the price, what are our levels? Well, I think we can move this level down a touch more, given the fact that we've had a few responses in this level. And what I'm going to do is I'm going to split the difference. So I'm going to split the difference between the last 3 tests that we've had here. We've come down, created a stop run on the 60-20 level, came down, tested that level again, and once we came back up, we tested that level 60-20, tested it almost to the pip again. So as far as a midline point, I'm going to use the 60-20 level. The 60-66 level doesn't have to change. We never came into that point, and thus it doesn't have to change. Now, the one point that I am going to change and move down just a touch is going to be the 50-59 level. I'm going to call that level 50-56 now, given the fact that we've set a new closing price low, and I'll move that down just a touch, move it down a few pips to correlate with the fresh low that we have. That also correlates with the hourly 200 EMA, which adds to the validity that there's going to be orders sitting in around that level. Below that point, we don't have a whole lot. So the next level I'm going to look at is going to continue to be 58.86. It's a long ways away, but with the pound, I'm not necessarily I'm not really worried about the fact that these levels are spread out. That's kind of a good thing. I'd rather see bigger levels spread further out. That gives us more opportunity to take our 2-to-1 in between the levels, and it also means that we're trading off a little bit bigger manipulation points, which is always safer. With the euro hasn't changed in my opinion. I think it's possible to lay it out the way Chad has been laying it out, which is short cycles to the downside. But for me, if it's not satisfying the criteria of a push, I'm not going to try and force cycle on the market, meaning I'm not going to try and force a cycle into a market that is really just, this is kind of the best way to illustrate it. You draw your, for lack of a better way of saying it, your trend line, and you look at what this thing has been doing. It's been staying within roughly about a 40 pip descending range, and that is a extremely stagnant market for 3 days. You got to figure this thing has been in that stagnant back and forth for 3 days now, and that's pretty tame. I mean, that's a pretty long period of time. It is very normal that the market will stay stagnant for a few days after, or a day, maybe 2 days after a big move. But 3 days starts to get a little excessive. Now, it's really looking more and more to me like, and I would be much happier with seeing a stop run of the lows for the push up. This is typically what I'll term as an inverse trend channel, and that is you see a major push, and then you see the market make a trend, a shallow trend against the previous major move. And what's happening there is you're getting this succession of lower lows and lower highs. So it's creating the perception of a downtrend. And when you get that perception of lower lows and lower highs, what's happening? Well, every progressive lower and low and lower high, you're getting people to continue to sell and sell and sell. It's progressively slipping through the lows. You're inducing more sell orders, more buy orders that are getting, or people that are long getting stopped out, having to sell that position back, and thus creating more sell orders, allowing them to buy into that selling market. So totally would not shock me if we saw the stop run of the lows for the continuation up. Now, to the downside, we still have, probably zoom out a little bit to go back to this level. We still have the 40-47 levels, the high back on the 20th of August. If we go back to the current price, you can see what that level is. Basically coincides with that lower level on the pound coming in at the 200 EMA, but it's about the best that we have going into the 15-minute here. And looking at the move up, this really aggressive move up, obviously there just wasn't a whole lot there to judge a resistance point from. So the best point that we do have is going to be that 44-47 level. And that's going to be the lower point that I look to work from. Now, at this point right now, we have a low that I would work from, 34.64. However, this low, it looks like we may be starting to break that low or getting close to breaking that low. So if that low breaks prior to the start of the European session, then I'm not going to be using it, and I would just be looking forward to long off that 34.47 level. So that 34.64 level does have a bit of stipulation when it comes to using it. Now, this 34.85 level, I'm going to be moving that up a touch, and I'm going to move that up into the 34.92 level. 34.92, zoom in to show you that one. Okay, so 34.92, basically, the price responded to it a couple times. Let me get rid of this 3,500 level. We're not going to be using that. But when we were above it, we came back down, held during the European session, held a pretty aggressive candle to the downside, rejected back up, came back down, held the price for 45 minutes there, and finally broke. Once it did break, we came back up. We held on that level many times. It is a very clear last short-term high, and thus I'll look to use that as a potential shorting opportunity as I continue to trade the euro like we're in level 3 accumulation, because we don't really have a dominant cycle based on traditional cycle rules. Alright, to the upside, beyond 34.92, we have a solid point, and this is a high that we established at the beginning of the European session. It coincides with the previous high we set late last New York, or late in the New York session, the last New York session, and that level is 35.14. So as far as to the upside, the 35.14 would be the last point that I look for. You can leave in the 35.44 level. It's just very unlikely that we'll actually get to that point as a potential shorting point for the euro. But again, we can leave it in there as as it could be a potential stopping point for the day, should the market make a really solid push to the upside. So have to wait and see on that. It's just a little less likely it will actually get into that point. So that's going to do it for the levels here on the euro and the pound. As always, if you guys have any questions, feel free and shoot below the video, or give us an email. We will get back with you. But again, that's going to do it for the review. Until next time, happy trading.